Can you see the sir? Patnaik sir. Dr. Prabir sir, can you see the screen?
Sir, yes, sir,
sir,
please okay.
You can share the screen, but be in the first slide mode.
Now can everybody see the screen?
See in the.
No, sir, it is not able.
Okay, sir. You can continue. We are having the time. 5 minutes.
No, just I want to
Check it.
share the screen.
Good afternoon to all. I am Dr. Praveen Kumar Padi. We welcome you all in the one international webinar, a comprehensive insight into external debt and its impact on economic development. Really, it was a dream for us after that establishment of this small online research institute. Long way of exactly 1 year. We have a dream that we can organize a small international webinar, and for which I'm very much thankful on behalf of IPREMS Dharampur, Dr. Ashok Patnaik sir, for your kind support. Before the starting of this webinar, I would like to say something about this, why we have chosen this topic. External debt is the portion of a country's debt that is borrowed from foreign lenders through commercial banks, governments, or international financial institutions. A debt crisis can occur if a country with a weak economy is not able to repay the external debt due to an inability to produce and sell goods and make profitable return. Countries borrow from foreign creditors mainly to finance their own assets, their expenditure, build infrastructure, to finance recovery from natural disasters, and even to repay its gross external debt. Debt can impact adversely to us, to a country like India, or the medium and long run economic growth. High public debt can negatively affect capital formation, long term interest rate, higher discretionary tax rate, increased volatility, and lower growth rate. So far, we have chosen this topic, and we have so much delighted to hear the two eminent resource person in this one day international webinar. We have Dr. Surendra Badapalisha and Dr. Suresh Naik sir in this one day international webinar. So, from the IPREMS Dharampur, on behalf of this institution, first of all, we would like to invite the debt resource person, Dr. Suresh Naik sir. Dr. Suresh Naik sir completed his PhD in economics from Hyderabad Central University. He has around 8.5 years of teaching experience in academics and research institutes. He was a prominent academician in the institute, organizing many webinars, workshops, FDBs, and acted resource person in many of the FDP's workshops in various periphery of the nation. He has also published many articles in the peer-reviewed journal and UGCK journal and many more. Along with this, he has participated many national and international conferences. His research interest is banking and finance, human capital, and foreign direct investment. He is currently working as an assistant professor in the regulatory institute like Institute of Insurance and Risk Management, Hyderabad. We welcome you, sir, for this for your wonderful presentation. And now it's over to you for the basic and fundamental of how the external debt is impact to us. It's over to you, sir.
Thank you, Dr. Praveen Kumar. Can you hear me?
Yes, sir.
Hello.
Yes, sir. Yes, sir.
Okay, sir. My screen is visible to everybody.
Yes, sir. Yes.
Okay, sir. Good afternoon to all. And I will thank Dr. Praveen Kumar for giving this opportunity to present on this topic, and my colleague, my friend Ashok Kumar Patnaik also. Before we go into this topic, the first thing we should understand is that at this moment, this external debt concept is rolling across the world. Why it is rolling across the world is the most important factor is that presently the impact of COVID-19 on the expenditure of the many emerging countries, it is hitting hard on them. And in this process, we can understand that even the Indian economy is not isolated from this impact. As we can see, the data said that from last 2019 20 March to 2021 March, around 11.1 percentage of your external debt has increased. And why it has increased? What is the reason that has increased? The one of the reason that it has increased is due to the COVID-19. Because why it has increased? Because your major economic wheels of your country have stopped. Your economic revenue generation has stopped. Your economic development has stopped. You may understand that in 2020 we went to the negative rate of growth rate. So in this process, when your economic wheels have stopped, and there should be certain kind of revenue generation should happen in your country. To overcome that one, have a lot of capital expenditure in your bucket, we should require extra fund for that one. So in this process, the finance minister Sitaram has approached external banks, external world in terms of helping us in terms of filling this gap. Okay, before we go into the depth into this external debt, the few things which it makes very much clear is that as we all know from economic streams and other management streams have this, the capital accumulation plays a very important role in terms of the growth and the development of your country. And today, when we talk about capital accumulation or endogenous growth theory concepts, they say that your capital plays a very important role in terms of enhancing your economic growth and development in your country. So in this process, the many emerging countries, developing countries are going for the external debt in terms of fulfilling that lack of capital within the domestic economy. Okay, so when we see that one, I'm going to stress on that one that when your domestic capital accumulation is less, then we cannot enhance our growth to the large extent. So what is the other source of revenue, other source of a capital where we can get that capital and see that your economic development take places? The one kind of a source is your external debt. So now majority of the countries are using external debt as one of the instrument to fulfill their lack of capital in your country. So as a result of that one, you can enhance your economic growth. But there is other dimension of this external debt. If it is used the wrong way, it has a wrong impact on the economy. So my presentation is going to be around 20 to 25 minutes. So basically, I am sticking on the theoretical perspective. Why external debt? What is the benefit of external debt? Whether if it is used in a proper way, how your economy is going to have a larger scope of development, growth and development. Okay, in this framework, my presentation is going to fix. So, okay, as Dr. Praveen has already explained what is external debt, I don't want to stick on that one. The basic thing which the external debt is basically focused is that a borrowing from the foreign lenders. It may be commercial banks, governments, and international financial institutions. And one important thing you should understand is that when you are borrowing from the international bank, when you are borrowing from the international banks or a governments, they are lending in their own currency to you. Again, when they pay their in their own currency, the interest rate is also charged in their own currency. So as a present economic condition, you may have heard that 2008 crisis and to the again Asian crisis happened. And what was that major reason that if US economy goes down, it has a larger implication on the other economies who are on that. Then your valuation of your loans will be taken place, and again because of that valuation of loans, you are able to pay more loans in the take place. So what happens is that the external debt, it looks fine things for the outer scope, but it has a lot of inner meaning in terms if you're not using that external debt in a proper way. So before this is what a larger definition we talk about is that if you go for the purpose of external debt, if you go for the purpose of external debt, why we use this external debt? One of the major things, as I told you in the initial talk, is that because majority of the developing emerging economy are suffering due to lack of capital expenditure in their economy. So when there is lack of capital in their economy, they cannot build a larger infrastructure. They cannot have a proper industrial growth because again, if there is no proper industrial growth, then the employment opportunity will not take place. If the employment opportunity will not take, your income, the per capita income of your country falls down, and it has a larger negative impact on the living of your people. So what happens is that to overcome such kind of a deficiency of your capital in your country, countries are approaching the external debt, approaching for the international market to get external debt to fulfill that lacuna in terms of the capital expenditure, in terms of the expenditure. Because if you have a capital expenditure, you can have a more investment, more industry, more developmental activity can take place. The more infrastructure can be created. If you see the Indian case also, because when we see the recent budget also, they have laid a huge amount of the capital expenditure because they want to create a larger infrastructure facility where this infrastructure industry can take care of larger employment opportunities in your country. This is where one argument is that it takes care of your expenditure issues. And the second one is that why the majority of the countries are going to the international market. So there is, as theory says that if the government starts borrowing more from the domestic market, there is a crowding out effect. The crowding out means the private sectors have left less money with them in terms of investment and activity. To overcome that one, the governments are going for the international market and they are buying so they're borrowing the money from the international market. And other advantages is that the rate of interest which we get from the international market is lesser than the domestic market. So now the majority, not only government is going for the external market for buying, the government, even our many big companies are approaching the big market under the external commercial borrowing. So I'll show you the data that how the things are moving. So this is the purpose and need for the economy to grow, and what is the source of a capital is that the external debt. So that is one of the sources of external debt. So these are the few presumption which is given by the economists, policymakers, that if we are able to overcome this basic criteria, then your economy can take place in a better way, where development activity can take place. So what is this advantage of external debt? If you see this advantage of external debt, many things are there. One is that, as I told clearly, that the investment which you're going to get, the capital which you're going to get from the international market is at a lesser interest rate. So if you are able to use this capital in a better purposes, what happens is that if you use this capital in a better purposes, it enhances the investment activity in your economy. Once your investment activity enhances, it creates employments, a generate stream of revenue, which not only benefits which benefits the state in terms of increased tax revenue and also consumer who receive higher level of income. So that's what I was telling you, that because developing countries are facing lack of capital. With the lack of capital is that we cannot catch the developed countries. For the to catching up with the developed countries, we require a capital. So one source is that external debt. Use the external debt in a proper way, where we can use more investment activity, more industrial activity. As a result of that one, it creates employment opportunity in the economy. Once, as we know that once your employment opportunity is created, automatically the rest of the factors are taken care of very well, and it leads to a higher growth, higher income, and higher development in your country. If you take the East Asian tigers, we call them, they grow at a very fast rate because of the huge investment activity that took place in their economy. Large capital flow took place in their economy. As a result of that one, we can see that external debt, if it is properly used, it can be a game changer in terms of a developmental activity. Again, as you know, that once the investment activity is increasing, and automatically your income of your country also increases. Once the income of your country increases, we think of welfare activity happens. So welfare activity in the sense that new schools, new hospitals, this kind of a welfare schemes can be developed through the use of this external debt. And many nowadays, many I'll show you the data that the many borrowings earlier used to be like concessional borrowing, but today it is not a concessional borrowing. It has become a commercialized borrowing rather than the concessional borrowing. I'll show the data how it is going down. Okay, so this is where if you use the purpose of external debt, it is properly used, then that has its own advantages, and these advantages can lead to the economic development of your country, that it has a larger positive effect in terms of a growth and the development. So next is that, as I told, there is always advantage, there is also a disadvantage. As I told you that if you use this external debt for paying up your interest, then it is not a good purpose, because we have seen that the majority of the developing countries, you can see that their external debt is increasing day by day, because their ability to repay loan has come down drastically because of a lack of investmental activity, lack of economic developmental activity. So as what happens is that if use large amount of your external debt need to be repaid, then there is a less money is left left for the investment purposes. As a result of that, what happens is that it affects your economic growth. Once it affects the economic growth, automatically other indicators is also affected. Again, one more, the long gestation period, when you take any project, long period of time. So once the project starts, and return on investment, the project started already, it has been 5-10 years. So 5-10 years we have to pay interest payment. So it has its own activity in terms of long-term investments. Again, the most important thing is the vicious cycle of a debt. Here, the most crucial disadvantage of external debt is that it leads to vicious cycle of debt for countries. What is basically here? What happens is that you are borrowing from one country, you accumulate the payment burden, and eventually you will default. To overcome that default, again you go for other country, you borrow money from that country, you pay rent to that. So what is happening is that you are using your external debt to repay your loans which you have taken, external debt which you have taken from other country, because otherwise if you don't pay back their loan, your country will fall you're in a sovereign debt crisis. So as a result of what happens is that your country will be rated as a negative, where they will not lend you any more loans to you. As a result of that, what happens is that you will be blacklisted. So what happens is this vicious cycle of debt is a very important for country to overcome, because that's what I was telling you, that when you're using your external debt for the good purposes, good investment purposes, and you're repaying the interest at the right time, then you will be rated as a good country. Then many countries will come to you pay more loans. Okay, this is where the countries the countries should not fall into the vicious cycle of a debt. If the countries falls in the vicious cycle of debt, then the country's progress and development will come to the halt. So this is basically the two perspectives you should understand before going to the next level. One is that uh, when we talk about external debt, it has a positive and negativity. So how you use this external debt in terms of making the positivity from that external debt, creating a new infrastructure, new investment opportunity, new employment opportunity, new once you create a new employment opportunity, automatically the people will be having income. As people will be having a more income in the hand, the government having a more tax revenue in the hand. So as more tax revenue in the hands of the government, then more economic activity takes place. That is the advantage. The disadvantage is that you have taken loan, you are using that for the some other purposes, or more corruption is happening. We can see that India is wherever we get money from the IMF, World Bank for the developmental purposes, it is not used properly. If that is the case, in that case, what happens is that you are a falling vicious cycle of it. So this positive purpose, using your external debt for your overcoming your loans or repaying their loans. If you use that one, there is no use of your external debt in the country. So if you see the case of India, in the case of India, you can see that over a period of time, I want to show you that over a period of time, we can see here the two things I want to highlight is one is that the external debt in terms of billions is around $570 billion. Today we have external debt, and the more important is that external debt to GDP ratio is around 21%. Is higher than the all time. It is higher than before 96. So today is around 21%. So the more important one should understand is that debt service ratio, repaying ability of your country. You can see that debt service ratio is also increasing compared to earlier. Means your country is able to have the large scope in terms of repayment. The one more is that your foreign exchange ratio, as we know that is around 570 or 600 plus $billion of foreign exchange reserves we are holding today. Means even if you want to repay back $570 billion of your debt, still will be having the money with us to repay. Right. So this is where the larger trend of your data set we can see that happens. And the one more data set which is the composition pattern of your external debt. So here one should understand on two things here. One is your commercial borrowing and NRI deposits and total long-term debt. Because there are many economists, they say that if the country is totally focused on the total short-term debt, then the country is in a dangerous. So here we have the more of a total long-term debt that is around 468 billion dollars, whereas the short-term debt is around 101 billion dollars. Means it is not, we are not in any such a dangerous position where we can say that the country is going to debt trap or the country is going to vicious circle. So one more important factor which I want to put into is that if you see that whenever we borrow from different countries, but in Indian case we are more around 51% or 53% of our loans are borrowed from the US and under the US, and rest of the borrowing is held under the Indian rupees, that is from the Japanese Indian rupees, that is 31.9% and 5.6 under the Japanese. And so these are the different things which shows that the Indian economy is not under the impression that it is going towards a vicious circle trap or something else. It is stably looking into things that way you can use it to the betterment of your economy and developmental activity. So from this one we can see that again commercial borrowing, we can see that it is increasing from day to day. I show you the graph of that one. So here the major debt indicators in India. You want to just focus on this concessional debt is what green line. Actually, earlier, if you see up to 2003, 2004, we used to get a lot of concessional debt from IMF, World Bank, and the majority of the world economies whenever they used to lend. But from over a period of time, it is coming down. And one more indicator is the short-term debt. It is your blue line. It is going up. and the debt stock to GDP ratio is also stagnant over a period of time. But the short-term debt is going up due to because of larger demand for the short-term loans. So this is where debt service ratio has been stagnant over a period of time, where your repaying ability has been consistent over a period of time. So this is where the your trend says that the country is not into such a huge trap, but it is maintaining its basics very well in terms of looking that way we cannot cross certain limit. So here, before going to the next section, there is a theoretical perspective is that there is a concept called inverted U or a non-linear growth. What is this non-linear growth is related inverted? Means whenever you use your external debt in a proper way, that has a non-linear means it doesn't impact directly on your growth, but it has its own wings where it can impact on your growth. So here when you say when you talk inverted U, up to the certain level your debt will play a crucial role. But after crossing that optimal level of debt in your economy, it has a negative effect on the debt. So as a result of that one, the countries should decide that what is the optimal level of debt one can borrow from the international market, where it should be added to the growth and development of your economy. So if that basics are not handled properly and you are taking loan irrespective of understanding your basics and you're borrowing more loan from the international market and your repaying ability is going down from day to day, and once your repaying ability goes down from day to day, then automatically you have fallen into the vicious debt trap. So this is where the larger theory has put their picture in terms of optimal, deciding the optimal level of external debt, where this external debt can play crucial role in terms of the growth and the developmental activity. So in that perspective, there are some of the studies which I want to put here that, and here when as I told that when your short-term borrowing is increasing, it signals for the more towards the sovereign debt. That's what I'm telling you. Because even I showed the previous that your sovereign debt in the Indian case also, it is increasing from the short term earlier to long term. But now the trend of short term debt is increasing. We can give example because of this COVID-19. We want to borrow more from the international market for the short term, but at the same time we should pay interest at a very short term period also. Okay. So again, if use this external borrowing for the channels into investment, then it's a wonderful process of achieving your economic development and growth. And one more by study by Cotariel, and they indicate that repaying sovereign debt arises for a combination of long maturity and the composition of debt, which most of the emerging market are foreign currency borrowing, floating rate, index rate. Means basically, your economy should be in a position to have the composition of where it should not impact your long-term perspective of your economy. So so in this way, what happens is that wherever the higher level of indebtedness, what happens is that the increase in the external debt to GDP ratio, it will hurt your growth. And if even by increasing your external debt, if it is not used in a proper manner and it is not used in a proper productive purpose, it really impact your economic development and growth. Okay. So like this, many people what they again if you see this recent paper by Ray and Tariq, they said that if your external debt is not properly used, then it has a larger positive impact of your macroeconomic policy indicators. Means that's what external debt on GDP growth, it has a negative impact if you do not use in a proper productive way, where it will not only it will shakes up your basic structure of your economy, and also it will affect your macroeconomic indicators, where in the larger space your country is in a crisis. That's what basically many papers are coming up with this one. Okay. And there is one more theory is there that is called debt overhang theories, and they also they try to say that the model argues that if there is some kind of likelihood in the future debt will be larger than the country's repayment ability. Means if you don't have ability to pay your loan, then I think it will create a larger negative impact on it. So the larger debt stock would lower growth through channel of reduced investment. So what happens is that when you take loan from one country, you are not able to pay him. Then you go for other country, there also you take loan, you're not able to pay him. So at last, what happens? The trust on your country, and they will not give any more loan to your country. As a result of what happens is that the total investment activity comes down. As a result of what it will affect economic activities. So this is where it's very important. That's why they say that whenever you use this external debt, you should have an efficient macroeconomic policy environment. If you have an efficient macroeconomic policy environment, then it has that which is likely affect the efficiency of investment. If you don't have an efficient macroeconomic policy, where your country is going to the high corruption rate, using this money for the self purposes rather than investment purposes, automatically it affects the efficiency of investment. So this is where different theories they put is, but overall the picture of the theories we can put it like this is that we can put it in simple ways that you are taking a loan from the country and you're using that loan for the productive purposes, and the output is better, the growth is better, then you are in a positive side. No, if you are taking loan and the corruption rate in your country is very high, you're not using for the productive purposes, then you are falling into because of your poor economic policy, then the efficiency of investment is coming down. As a result of what happens is that the purpose of capital accumulation fails and the development activity comes down. So once the purpose of your capital accumulation fails, what happens? Other economic indicator also fails. When the other economic indicator also fails, then what happens? The developmental activity will fall down. Once the developmental activity falls down, the poverty level of your country increases, unemployment rate of your country increases, and it leads to a larger revolutionary aspect in the country. So domestic capital accumulation, international borrowing, this should be used in a proper channel to see that we can have a larger output in the economy, a larger GDP growth. And once the GDP growth is higher, then we can see that your economy is growing in a very positive way. So on the basis of this work, we have highlighted some of the way forward where the many economists and the policymakers are suggesting that if the present COVID-19 situation further enlarges or further extended, then again we can see that there is an increase in low external debt. Last 1 year, it has increased to $11.1 billion. There is a shift in 11.1% in terms of external debt. So as a result of that, anyway, we are going 9.1 to 9.3 of your physical deficit, so that can again enhance that physical deficit further, where in the coming days economic development activity or the investment on the development activity may come in Indian case. So it's better that we keep a track of your physical deficit. If the physical deficit further charges, then we are into the problem. Again, as we know that as your physical deficit is enlarging, again the repayment of your service and debt will be a big challenge for the country to see that it is taken care of. But in this Indian case, the few factors which we should also consider is that one is that your increased capital flows. For example, the foreign direct investment and your foreign direct investment has increased drastically. From you can see that it has increased. It is increasing, so that will be taken care of certain part. Again, we can see that your exports are also increasing from last year to this year also. So if your export is increasing, the capital flow is increasing, then automatically there will have a plus point for our economy in terms of taking care of your deficit activity. So the most important challenge for the Indian economy is that as we saw in the first wave, the COVID wave, where the lockdown, total lockdown happened, as a result of your economy came down to negative rate. If that kind of a situation arrives in the future, then again economy is in a crisis, but hope for that level will not reach, and as a result of that one, your external debt will also come down to the normal level, so normal rate. So this is where again we can see that the Make in India movement, which is started by the Modi ji, and it has today yielding certain result in terms of export has increased. So if this goes on increasing, because one of the drawback for export is that what kind of a product we are exporting. it is a precious item. That should not be taken. We should export industrial items. If that will increase in Indian case, then we can see that our economy can take place in a better shape, and we can see that larger growth. And again, we can see that our IMF also has predicted that it's around 9.2% the GDP can grow at coming days. If that goes on in a better manner, then you know. But if your GDP growth falls down, other side your physical deficit is increasing, again you are borrowing more from the international market, then we are into the problem. So we should see that our GDP should grow, FDI should grow, export should grow. If that is taken very well, then we are in a sufficient space to handle external debt, where we have the different capacities. In this way, if you are able to see our economy in terms of coming days, then I think external debt will be a major play in terms of economic development. So this is here. Again, one more thing I want to show you is that you can see that this is some of the graph you can see from the last couple of years. You can see the external debt for the emerging market is increasing drastically, because there is a more people are demanding more loans from. But one of the drawback is that your debt is increasing, but output growth is coming in. This is what I was telling you, that it is not used in a proper manner. Majority countries are taking loans from the international market to repay their loans which they have taken from the market. That's why there is a totally inverse relationship. On one side, your total debt is increasing, but output growth is coming down. If that is happens, that is really a dangerous signal for the majority of the economies in the world. So, but we are not. Indian economy is not in that position, because we have some of the positive indicators like FDI is increasing, export is increasing, and also our GDP growth is also increasing. So, given this fact, our economy is still in the basics are strong. Our economy is stable. So here I end the presentation. Thank you.
Thank you, sir, for your presentation. We have learned a lot from your presentation, like what is external debt,